Your company just offered you a Supplemental Executive Retirement Plan, a SERP. Your employer defers $500,000 of your salary over the next 5 years. You don't pay tax on it now. Your employer gets a tax deduction. On paper, you've saved $175,000 in federal tax at the 37% bracket. It feels like you've outsmarted the IRS. But here's what nobody tells you. IRC Section 409A doesn't defer your tax bill. It just hides it until the year you leave the company. And when that bomb explodes, it could cost you $150,000 more than you expected. Let me walk you through exactly how this trap works, and more importantly, how to avoid it. # the SERP promise vs. reality first. Let's understand what your HR team is actually offering. A SERP is a non-qualified deferred compensation plan designed specifically for executives and highly compensated employees. Unlike a 401k, which has annual contribution limits of around $23,500, a SERP lets your employer defer unlimited amounts of your compensation. Here's the pitch. Over 5 years, your company will set aside $500,000 that would normally go into your paycheck. You get the money as a lump sum or installments when you retire, change jobs, or hit a specific age trigger. In the meantime, you avoid paying federal income tax on that $500,000. At the 37% federal tax bracket, that's $185,000 tax savings, making it seem like free money. Add in state income tax at, say, 5% to 10%, and you're looking at total tax savings of $225,000 to $250,000 on that $500,000 deferral. But here's the critical flaw. You haven't actually saved taxes. You've just borrowed from your future self at the worst possible time. # the IRC Section 409A problem. How one mistake costs you 20%. In 2004, Congress implemented IRC Section 409A to prevent executives from gaming the system. The rules are strict. If your SERP doesn't specify exactly when and how you'll receive your money, the IRS will treat the violation as immediate taxation of the entire deferred amount, plus a 20% penalty, plus interest dating back to when you first deferred the money. Let me show you what this looks like with real numbers. Scenario, you defer $500,000 over 5 years into a SERP. Your company's legal team doesn't file the plan document properly, or the distribution provision is ambiguous. You retire at age 62. IRS penalty calculation, deferred compensation, $500,000 federal income tax, 37% bracket, $185,000 state income tax, 7% average, $35,000 IRC Section 409, a penalty 20%, $100,000 interest, 6 years at 8% annually, $48,000 total damage, $368,000 in taxes and penalties on money you thought you'd received tax deferred. You don't get to simply pay the original tax you deferred. You pay the tax plus a 20% non-deductible penalty. That's equivalent to being audited with no appeal. The IRS doesn't negotiate on Section 409A violations. It's automatic. This happens more often than you'd think. A 2019 analysis by the American Compensation Association found that approximately 15% of SERP documents contained technical violations that could trigger Section 409A penalties. Many executives never discovered these violations until they tried to claim their deferred compensation. # the income bunching trap. While your tax bracket explodes, let's assume your SERP is perfectly compliant with Section 409A. You've documented everything correctly. Your payout is scheduled for January 1st of the year after you leave the company. You've still walked into a trap. It's just a legal one. Here's the situation. You've been earning $400,000 per year as an executive. That puts you squarely in the 37% federal tax bracket, with some additional tax exposure from net investment income tax (NIT) and alternative minimum tax (AMT) calculations. Now you retire. On January 1st of your first retirement year, your company deposits $500,000 into your account. That $500,000 is fully taxable income in that single year. Your tax situation that year: regular retirement income, Social Security pensions, $60,000 SERP payout, $500,000 total taxable income, $560,000. Here's where most people do the math wrong. They think, I'm already in the 37% bracket. So 37% of $500,000 is $185,000 in additional federal tax. Wrong. When you bunch $500,000 into a single year, you're not just paying tax at your existing marginal rate. You're creating marginal rates that don't exist in normal years. Let me break this down. For 2024, the 37% federal bracket starts at $609, $350 for single filers, and $731, $200 for married filing jointly. But there's more complexity. 1. ***, the additional Medicare tax kicks in *** at $200,000 for singles, $250,000 married. That's an extra 9% on wages above that threshold. 2. ***, the net investment income tax *** applies to unearned income if your modified adjusted gross income exceeds certain thresholds. If your SERP payout includes any investment gains, this could add another 8% tax. 3. ***, state income tax bunching ** means you're paying state tax on the full $500,000 in a single year rather than spreading it across 5 years. In California, this could mean jumping from 9.3% to 12.3%. Realistically, when you account for all taxes on that $500,000 lump sum, you're looking at effective tax rates between 45% and 52%, not the 37% you calculated. Let's recalculate. SERP payout, $500,000 effective tax rate, federal plus state plus NIT. 48% actual tax bill, $240,000. Remember your original calculation? You thought you'd save $185,000 in federal taxes by deferring. Instead, you're paying $240,000, which is $55,000 more than if you'd simply taken the $500,000 as salary spread across 5 years. # real case study. The executive who lost $127,000. This happened to a real CFO in 2018. Let's call her Sarah. Sarah's company offered her a $400,000 SERP to be paid in a lump sum upon retirement. She was earning $350,000 annually and was comfortable with her tax bracket. She accepted the offer, thinking she'd save roughly $150,000 in taxes by deferring. 5 years later, Sarah retired. Her SERP payout was triggered. Here's what actually happened. SERP payout, $400,000 retirement income, Social Security plus small pension, $85,000 investment income that year, $45,000 total income in retirement year, $530,000. Tax bill breakdown, federal income tax, $196,000 state income tax, California, $46,800 additional Medicare tax on wages, $3,600 net investment income tax, $1,710 total, $248,110. Sarah paid $248,110 in taxes on a $400,000 payout. That's a 62% effective tax rate for that year. Now compare this to what would have happened if she'd simply taken the $400,000 as salary spread across 5 years. Average additional annual salary, $80,000 annual tax on $80,000 additional income at marginal rate. Approximately $27,000 total tax over 5 years, $135,000. Sarah saved $135,000 in taxes by taking installments instead of a lump sum. But because she had structured the SERP as a lump sum payout, she paid $248,110 instead. Difference. Sarah paid $113,110 more in taxes than necessary, plus she had to cover her living expenses from the after-tax proceeds. # the counter-argument. When SERP actually work. Now I want to be fair. SERP aren't always a mistake. They can work brilliantly if they're structured correctly. The key is distribution timing. Instead of taking a lump sum, savvy executives structure their SERP with installment payments spread across their retirement. For example, year 1 of retirement, $100,000. Year 2 of retirement, $100,000. Year 3 of retirement, $100,000. Year 4 of retirement, $100,000. Year 5 of retirement, $100,000. Now you're spreading the income over 5 years. If you have lower income in retirement years, no W-2 wages, limited investment income, you might be in a lower tax bracket. The effective tax rate could drop from 48% to 32% on a $500,000 SERP lump sum scenario. $240,000 in taxes, 48% rate, installment scenario, $160,000 in taxes, 32% rate, savings from proper structuring, $80,000. This is why the structure matters more than the amount. # what you must do right now. *** first, review your SERP document. *** get a tax attorney and an employee benefits specialist to review it. Look specifically for clear definition of payment triggers, retirement, termination, death-specific payout schedule, lump sum vs. installments vs. annuity, documentation that the plan complies with IRC Section 409A review dates. Plans should be updated every 3-5 years. ** second, model your distribution scenario. ** work with a CPA to calculate what your tax bracket will look like when you retire. Most people assume they'll be in a lower bracket in retirement, but that's not always true, especially with mandatory IRA withdrawals, Social Security taxation, and investment income. ** third, consider installment payments. ** if your company allows, structure your SERP to pay out in installments across 10 years rather than a lump sum. This is the single most effective way to reduce your tax exposure. ** fourth, coordinate with other retirement income. ** your SERP payout should be coordinated with your Social Security timing, required minimum distribution timing, and pension payout options. A $500,000 SERP payment in year 3 of retirement could trigger taxation of your Social Security that would otherwise be tax-free. # the bottom line, a $500,000 SERP deferral feels like a tax win today, but without proper structuring, it's a tax trap that will cost you an extra $100,000.